to my left is Jane Rowe. Jane is head of private capital for Ontario Teachers Pension, and they have actually been involved in direct investing for about 28 years. And you have a portfolio that's about 70% direct investments, 30% outside managers. Is that right? And you're global as well.
That's right. It's a $32 billion book, and our direct activity, like you said, it's about $23 billion of that. It's really done under two strategies, just to link maybe to the earlier panel just a little, Peggy. But the two strategies are we do typical LBO private equity deals done in conjunction with the GPs that we're backing on the other side of our book. And then the other thing that we do is what we call at Ontario Teachers long-term equities, which is really trying to find a long-term hold that's somewhere on the spectrum between infrastructure and private equity, that hopefully if we got it right, it's a little lower risk, a little more high cash yield, and it's good for the long term in our pension plan.
Great. And next to you is Patrick McCloskey. Patrick runs private investing essentially for Aeterna Capital, which is a family office-backed alternative investment firm. And Patrick, your focus is really on direct investing for the family office, essentially, right?
Yes, Peggy. We were set up about 5 years ago. I work for a European family office group, a multi-generational single-family office who historically had gotten their exposure to alternatives through fund investments, being a classic LP in a private equity fund or a venture fund. And they decided that they wanted more direct exposure to businesses, and particularly in the US, where they were underexposed. So I was living and working in London and met this group, and they asked me if we could create a business where they could gain more direct investment exposure. And I said we could. We had to figure out a strategy where we could be differentiated and competitive, and we settled on the lower middle market, really companies 2 to 7 million of EBITDA. And we're both an equity investor and a lender. So I think we're somewhat unique. We can invest really across the capital structure. We've made 7 investments to date, a mix of control investments and loans. And the mandate is to build a diversified portfolio across different industries in the U.S. as a direct investor.
Great. And Ian Charles, you're a partner at Landmark Partners, which actually has a long history and expertise in the secondaries market, which we haven't talked at all about yet.
Landmark is the original investor in private equity secondaries, really started the industry back in 1989. Also created the real estate secondaries market in 1996, and today manages just under $30 billion across private equity, real estate, and infrastructure. We also have a very large data and research business that helps LPs and GPs understand their programs better.
So I'll ask all of you the same question I just asked the panelists to start off with earlier. Where do you think we are in this cycle from your different vantage points?
I'd love to go last on that one. No, I'm worried. Leverage is the banks are very accommodative, the credit funds are very accommodative. Prices are really, really high valuations. I don't think any of us can look forward to enjoying an expansion of multiples going forward like we've enjoyed over the last decade. So it's worrying. It feels like we're at the top of the market, but there's a lot of capital out there, so who knows for sure.
Yeah, it feels that way. I mean, I know the next panel is going to talk about credit and the influx of non-bank lenders, and we see that quite a lot. I mean, leverage levels have really gotten pushed up, and even in some of these smaller companies where you get a bit nervous about over leveraging them, it does make you a little bit nervous. But we don't participate in that 10, 11 times much larger companies. We're down much smaller businesses, 2, 5, 6 million of EBITDA, where multiples, can be in the 4 times range. So it's very frothy. You just have to maintain discipline, and being structured like we are, and I think like Jane is, we can be a bit more patient because we don't have a life to our funds. So if we just think something is not structured properly, or it's just too out there on price, we just back off, and we always say we're not going anywhere. We'll be here in 3 months, 6 months, a year, hopefully.
I mean, at Landmark, we talk about cycles across lots of different strategies, lots of regions, different parts of the economy. So from a valuation perspective, it looks like peak pricing historically in equities across many markets. Similar to Elise's statement from KKR on the previous panel, we think there's very strong relative value in Europe relative to the US. The economy is very strong in the US, but it always is at the peak. And so for the last 18 to 24 months, all three of our strategies have taken very defensive postures in our portfolio construction, concentrating our capital with the best managers in the world in very durable assets that have weathered downturns very well historically, and using preferred equity when we can to mitigate downside risk.
So the topic of this panel is the changing face of the LP. What are some of the ways you think limited partners are different today than maybe they were 5 years ago?
I might even go baght to pre the GFC if I could.
Sure.
Because I think for Ontario teachers, when we were working with GPs back then, we did what I would describe as a sort of a syndicated co-invest. So the LPs take small little slivers of deals, and when we came to the GFC, we realized that we didn't have as a good a knowledge of the opportunity as we ought to have had, and we hadn't negotiated the right kind of governance rights that we ought to have had in that situation. And so either our GP was a bit stranded or we were a bit stranded in that investment. So we really stepped back and said, what are the kinds of deals that we want to do going forward? And they're ones where we had high conviction and we think it's a genuinely great opportunity because we've done diligence alongside the GP, and we've essentially helped them co-underwrite the transactions, and so the bulk of our book today is really shaped in that manner.
Well, if you take our class of investor, the so-called family office, which is a broad term, but family offices historically had gained exposure to alternatives through being an LP in, say, Blackstone's fund, and a relatively small proportion of a Blackstone fund. I mean, the public pensions or the private pensions or the endowments were really, the bulk of the LP base. But there's been so much family wealth that has been created over the last 5-10 years. It's just proliferated, and more families have organized and structured themselves as so-called family offices. And there are more and more groups like ours who are wanting to invest directly and realize that to do that, you have to structure yourself properly with the right resources, because as we know, investing in a fund is very different than investing directly in a business.
We're data junkies. We look at a ton of data, and I will tell you that the LP-GP relationship today is so different than it was a decade ago. If you look at the GP side, the amount of money that's been raised in this sort of historical fundraising environment, if you take the top 100 GPs globally, they've raised 65% of the money. The capital concentration is significant. Last year, 34% of all the money raised in private equity went to ancillary products from those top 100 firms. They were offering credit, they were offering infrastructure. The other thing that's interesting from the GP side is that the number of active private equity firms has been growing at a 10 to 12% CAGR for almost 20 years. Last year was the first year that number went down. So you have a consolidation of capital on the GP side underway, and most LPs aren't aware of it, but they're fighting each other like crazy to get access to those top 100 names. On the LP side, we see so many big and small LPs actively managing their portfolio today in a way that they wouldn't have 10 years ago. Deciding this is a core manager, this is not, and I'm just going to sell that non-core manager in a secondaries transaction. We see them much more active on the co-investment side. And I think the other dynamic on the LP side that's interesting is how they co-invest, how much they demand, how early they come in, and how much they're willing to underwrite. If you ask a room full of LPs who wants co-invest, 80% of the hands will go up, but only 10 will really be there to do the work side by side at scale. So I think there really is a bifurcation in the LP community on co-invest.
To that point, Patrick and Jane, you do a lot of direct investing in what you do, but what are the benefits and drawbacks of going direct that you've found?
We work with our GPs to get exposure to direct, probably for 3 reasons, and we have a team of 90 in London, Hong Kong, and Toronto. But really working with our GPs and underwriting transactions with them, we talk about the 3 E's, which is efficiency, education, and economics. And so we think working with our GPs actually makes us efficient. If we all step back and think about private equity, for every 100 transactions you look at, perhaps you go deep on about 12 of those, and maybe you go really deep on 4 or 5. You might win 1 or 2, especially in today's competitive world. So working with our GPs, hopefully we've at least stopped having to spend a lot of time looking at deals 100 down to 12, right? So it's a bit more efficient for us. Secondly, because we're based in Toronto and we have teams in Hong Kong and London, and we're a global firm, we need to work with partners to help us make us smarter in a sector or in a geography. And really, if we're finding the right GPs to work with, they're doing that for us. So hopefully we're getting the second E, which we call an education, from our GPs, and we can work together on that. And then the third one is really what we call economics, and that's because we're saving on the management fee and the carry related to the amount of capital that we've put at work in that co-underwrite or co-invest strategy. And from Ontario Teachers' point of view, that's really helped us generate the returns that we have.
I think what motivated our group to invest more directly, one was having more transparency on what was actually owned, having more input in terms of what's owned, what industries you gain exposure to. I think secondly, being able to manage liquidity is very important. For our group, ultimately they'll fund when they want to fund. Now we have an allocation, and we've made 7 investments, and we put together investment memos just like you would at a private equity firm. But ultimately, they don't have to fund something if they don't want to. So they're not getting a capital call that they have to meet. That's important. And third, Jane alluded to it, the economics. Just being able to control fees and the economics more is important. So I think those were the 3 real drivers to investing directly. But that's maybe we'll get into this, but as the last panel said, the key is deal flow. You can set up shop and put a flag in the ground and say you're a direct investor, but you've got to get out and generate the deal flow.
I would say one of the things that is interesting for us in the co-investment vertical, we do not today have a co-investment product, but we do help our investors understand where the best co-investment opportunities are coming from their roster of GPs. Another change in sort of the LP perspective over the last 10 years is LPs used to talk about IRR or quartile, and they still talk about those things, but today they also talk about alpha and excess return. And what our research has shown us is that even the best managers aren't great at everything. They're usually great at a few things. And if you can figure out what those are, maybe it's a particular industry at a certain size or a certain region, and you can orient your co-investment process with that manager around those small pockets of alpha generation, it can really lead to a lot more efficiency and better performance. So it's interesting to see how data is driving some of both the LP-GP relationship, but also specifically co-investment.
How is big data and the availability of so much data changing how you invest?
I would say for us at the pension plan, it's probably more relevant to our liquid markets teams. We have a lot more quants working for us than we did 10 years ago. And then as we think about our private portfolios, we're trying to drive some of the learnings that our quant teams have, and also step back and think about, are we coming at the digital world properly and data properly for some of the companies that we own, and what kind of interplay can we have there? And I would say, Peggy, we're in early days on that.
We're not really utilizing big data algorithms so much, Peggy, to find and even to underwrite opportunities. We're sitting down meeting with family-owned businesses, in the middle of, of the country. We did back a business, though, that does use one of these next generation lenders, team that we think quite a lot of, who use data and technology to make consumer loans, and they use it extensively, and they've been very successful. But we don't really use it so much. Although I would imagine we will at some point.
10 years from now, all of the big private equity firms will have teams of data scientists that are deployed on buy-side due diligence, sell-side due diligence, and operational improvements. Our research team works with the small handful of groups that exist today to help them understand how they can apply some of these tools into all the different facets of their investment process. But you can think about if a major buyout player has a big data approach to understanding revenue streams of a company that they're in deep due diligence on, they may actually understand revenue trends on that company over the next 12 months better than management. And if they can grab that insight in a competitive pricing situation and win, not on price, but on information, that is alpha. Right? And even if they lose on price, sometimes management will be so impressed with that data and how it can help them manage the business better, they'll find a way to bring them into the deal in some sort of security that does justify the risk. I think it will be a huge trend on both the GP and the LP side.
Talking about huge trends, and also, Jane, you mentioned this, the economics in some ways of co-investing or direct investing has been driven by the desire for lower fees. And we're seeing it across investment asset classes. But how successful have LPs really been in lowering the fees?
I love this question. So Ontario Teachers started doing investing in private equity, both funds and direct, back in 1991. And we're a pension plan, and I hope the room can appreciate this. But we have been doing it for 27 years, and I'm allowed to say this number by our chief financial officer, and we are a debt issuing organization, so the numbers have been audited. But over 27 years, net of management fees, carry, and internal costs, the team has generated 19.7% on average per annum for the Teachers of Ontario. And so we're super proud of the team that we have working for us, and would say that as an asset class, private equity is a high-risk asset class, but it is one that has consistently shown, if you do it in a disciplined manner, that you can outperform public equity markets. And that's what the plan asks us to do, and that's what they pay us for.
We don't disclose returns, but I would say our backer is happy with the fee versus return, equation. Yeah.
I mean, it's hard to deny that co-investments drive down the overall cost of a relationship with a private equity manager. That is one of the three E's, I think, is the economics, right? Part of the economics is the return. One component of the return function is the cost. Other asset classes have seen significant margin compression in credit, public equities. Private equity has had a much more durable arrangement with its clients, but through all of the co-investment scale that's happened over the last 5 to 10 years, you have this sort of shadow margin compression for the biggest LPs who can be active co-investors and help GPs more successfully deploy the capital on behalf of their funds.
And in terms of LPs and their alignment with the GPs, what are you seeing there? Because you have an interesting perspective, because you're seeing a lot of different deals come out in the middle of the process.
I mean, the typical alignment that a GP has with the LP is their commitment to their fund, and then the carried interest that comes from strong performance above whatever negotiated preference there is. I think some things have been changing in the asset class along that dynamic. You have just under a dozen publicly traded, very large global asset management firms that started out as private equity firms. And you've also had a dramatic increase over the last few years in the number of firms that are selling a piece of their business to alternative asset managers. They're called minority stake deals. And so I think one of the things that's changing in the LP-GP dynamic is that for some of the biggest franchises, there are starting to be questions from LPs around where is the alignment? Is it around the carry? Is it around the investments? Is it around the franchise? And in a market that's had this much growth, especially layered in with that concentration I mentioned earlier, it's a natural conversation between the LP and the GP.
Patrick, you mentioned deal flow, and sticking up the flag is not enough. Where are you seeing opportunities right now for deal flow that you think is attractive at these valuations?
Well, we've been very focused, Peggy, on what we call the baby boomer transition. I think it's well documented that 76 million baby boomers. There's estimated to be about 12 million businesses in the U.S. that are owned by baby boomers across all kinds of different industries. These are family-owned businesses. Oftentimes, it's brothers, it's husband and wife, and they're in transition. They've got a lot of their wealth tied up in the underlying business. They don't, a lot of times the children or the next generation doesn't want to get into the business. And, we show up at the table and we just try to listen to what they're trying to achieve. And oftentimes it's buying the company makes sense, but we'll only do that if the seller's going to roll a fair amount of equity and be aligned with us going forward, because the person that's lived in that business for 25 years knows that business much better than we will ever know it, has a tremendous amount of wisdom about the markets, customer relationships. So we want to be aligned with them going forward. And as we say, take a second bite at the apple, together down the road. But how do you get in front of that business owner? I think that's your question. And we're just old-fashioned blocking and tackling, finding local accounting firms and law firms and boutique regional investment banks. I mean, these are often not auction situations. It's very relationship-based. And the other thing we've done is we work very closely with other family office groups. I mean, that's been a real trend where we get together, we meet regularly, and these are family groups with real industry expertise and real business relationships. And it's very collaborative. And through that network, and it's a growing network, we have sourced some very interesting opportunities and co-invested with other folks. And we only see that growing as more and more groups like ours enter the direct market.
Jane, are you seeing that among pension plans as well?
Yeah, I mean, I think more and more folks are going into direct, and I think more and more of the pension plans are actually working with family offices, also in finding the right kinds of opportunities. I would say for where we are in the cycle, some of us that have been in this business for a while are probably a bit more focused on taking chips off the table and less worried about deploying more and more capital. We are trying to back some of our businesses that need to grow, and it's de-risking our book by working with companies that we already know and helping them buy, some companies that they're interested in. It's a bit less risky for us.
So just so I understand, you're not buying new companies, but kind of trying to help your existing portfolio of investments expand?
Yeah, I mean, we're de-risking the book by doing that, and we're de-risking the book by, Ian touched on this, but we're also doing more preferred shares today as a way of working with the company rather than pure equity exposure. So that's helping us de-risk the book, and we've also been selling a number of our assets. Also. So, whilst we're still doing, and we are still doing some new deals because you have to keep replenishing the book, but we have been taking chips off the table, I guess is the way to say it.
Ian, where do you see opportunities in the market right now? Do you see people kind of taking chips off the table and therefore, more opportunities coming up to sell for people, or what are you seeing?
I mean, for any market, the inefficiency comes from a place where there's more supply than there is demand, right? Those are really hard to find today. In the real estate space, there are not many real estate secondary buyers, so we see tremendous inefficiency in that part of our business. On the private equity side, there are lots of secondary buyers, and the valuations in private equity are very high, historically high. And so one of the things that we've done is pref equity, but we've also partnered with sponsors who, like Jane and her team, want to invest more capital in the platforms that they already own, that have de-risked, that they understand, and they have high conviction in the near-term opportunities to continue to invest in those platforms, despite those platforms existing in an older fund. And so we'll partner with great sponsors who want to own some of their best assets longer and create this sort of synthetic secondary exposure in an environment where we don't find tremendous inefficiency right now in private equity like we do in our other two verticals, real estate and infrastructure.
In terms of the power of the LP, how much has it changed in terms of beyond negotiating or pressuring for lower fees, other issues in terms of diversity in management or other issues like that? How much is that really coming to the forefront today?
You know, I would say relative to 10 years ago, and I would really give a shout out to ILPA on this for really helping move the standards forward in the last decade. But I would think we've made a lot of progress with our GPs as we think about transparency, as we think about understanding the fees that they're collecting and which pots those fees are going into. I think we're seeing greater transparency on valuation methodologies and how those GPs are thinking about making sure the right incentives are in place for the next generation of investors on their teams so that we have succession plans there for assets that they might be owning for 8 or 10 years, and we want to make sure the right teams are being trained and incentivized to stay and work on transactions. And then I would say, at least from Ontario Teachers' point of view, we have much more greater debate and dialogue with our GPs as we think about ESG issues that we probably weren't doing 10 years ago, and diversity is but one of those. Thinking about your labor practices, thinking about your environmental practices, and understanding where the GPs aspirationally want to go with their companies. That's important to the Teachers of Ontario. So we only work with 30 or 35 funds around the world. We look for people that are aligned and that are an extension of our footprint around the globe, and hopefully are not going to embarrass us with the Teachers of Ontario in some of their investments, and that they think about these important issues with a sustainable mindset on them.
In terms of this idea that Jane was just bringing up in terms of LPs pressuring their GPs to come into line, do you see that at all, Ian, in what you're doing?
So I think the interest that we see from our LPs around things like transparency, it's powerful. The LP today doesn't have an information request. They want to plug into the data. Right? They want real-time access. They want to be able to cut and slice that data. And that's a hard thing for GPs. That is a difficult transition to get to a place where that information is easily accessible for the client. So I think the whole industry is working on the information sharing and transparency with the LPs. On things like ESG, it is a high priority, especially in specific regions around the world for investors. At Landmark, we have our own ESG policy. And on the topic of diversity, that's something that comes up quite a bit in the asset class today. And I think ILPA, TWIGO, there's several organizations that are helping improve the diversity within the asset class. At our firm, it's been a huge push for a long time by our leadership, and it's something we're very, very proud of.
I think that we're feeling that as well in terms of social impact and making investments with a positive social impact. I mean, that's a broad term and can mean different things to different people, but our group is very focused on it, and it's meaningful, and it's going to become more meaningful. So we're actually working on defining that more and embedding that into our investment process. So that's coming, and I would say other family groups that we work with are thinking along the same lines. It's very much of a common thread.
And Jane, you have offices in Europe, North America, Asia as well. When you say you're taking some money off the table, are there certain areas of the world in particular, Ian mentioned Europe earlier, that you actually are seeing more opportunities in rather than less?
Yeah, I mean, I think it's fair to say we've done more selling of our assets in the United States, and we've been deploying more capital in Europe and more capital in Asia as we think about potential long-term pockets that should work well for us.
And has it changed over time, your access to other LPs globally? Do you actually partner with or work with or exchange ideas with investors all in different regions of the world?
We do, and I think that that's important. If anybody's come to Toronto, we're located north part of the city. It would be naive of us to think that we could have a deep understanding of a market in Asia or in Europe standalone. So it's important for us to have a network. It's important for us to have fellow smart investors, and if they're LPs working with the same GP, that's awesome for us. Or if they have a particular company that they want us to look at, we're quite open to doing that too, and vice versa. But it's really, knowledge sharing. It's a very competitive industry out there, and I think that the pension plans and the sovereign wealth funds, do want to make sure that we're thinking about things in a manner that hopefully none of us are being overly naive.
And I think that's a trend in the family office space as well, right, Patrick?
Yeah, we believe in strength in numbers too. Groups like ours are, we're pretty under-resourced from a human resource perspective, and that's on purpose, as are many other family groups. The capital's there, so we share a lot. The more we share, the better. I mean, of the 7 investments we've made, I think we've co-invested with other families in all of them. So it's definitely something we go out of our way to do, because when things are going well, you can work together to make sure they go well, and when things aren't going as well, you can divide and conquer and figure things out together. So it's been effective.